Welcome, everyone. Thank you for joining us for today's webinar. My name is Chris, and I am your host as always. Today, we are presenting our final lesson, lesson 6 of 6 for our cash flow webinar series presented by Mike Milan. I will
Hey
skip over the
guys.
housekeeping because you guys probably already know all that by now, but if you have questions, please put them into the question box. And without further ado, here's Mike.
Hey Chris, thanks again. This is it, man. This is the culmination. This is what we've been working towards for 5 weeks, right? 5 weeks straight, five in a row. This is number 6. So today, I'm going to tell you the end of the story, right? If you remember in the last episode, episode number 5, I left you with a cliffhanger, right? Whereas Sammy Spectrum, what he was doing is he was looking for a $300,000 line of credit. We had went all the way down through his financials. We've analyzed this guy inside and out. We started with the IFIs. With the IFIs, we had trends, we had expense control, we had a debt to equity, EBITDA, and misfinancing, and we determined that he was misfinanced, right? There was some part of his expansion that he financed with his line of credit. Our fix was, hey, if we just move the piece of equipment that you put on your line of credit off into long-term debt, that would just free up the amount of money that you needed on your line of credit. But then additionally, we went through and found out his borrowing need. When we determined the cash gap, which was inventory days plus AR days minus AP days equals the cash gap, and taking that against his cost of goods sold or his sales, it gave us a need of 500,000, and he only asked for 300,000. We knew we were going to put him in a bad position, right? So one of the ways we can fix that is also reduce his inventory. By bringing his inventory levels down to about 60 days, that put us around $312,000 and put him in the ballpark to actually, be able to service that true value contract. So with all that in mind, if you remember, myself, the banker, Sammy, his wife, and Junior were all at the table. We started to explain his options to him, Sammy's options to him. He was he was dismissive, he was argumentative, and finally his wife stepped in, said she'd had enough, stopped the whole meeting, handed me a piece of paper with 3 names on it. Of those 3 names, she said, I've been talking to these people over the last few years, and they said if I was ever going to sell this company, call them first. She said, Mike, let's go sell this company. And the meeting was over. No bank loans, no consulting, nothing. It was a sale. So, and I told you at the very end, we sold it in 45 days. 45 days, that's right. So, and if you know anything about selling, vehicle or selling a business, it takes probably 9 to 12 months is what you should plan on. This one went fast, mainly because of all the ratio analysis that we did. We uncovered all of these hidden opportunities. Now, let me tell you something about, selling a company. Here's the rule. First of all, there's 2 types of buyers, right? One is a strategic buyer. The other one is a financial buyer. Which one do you think you want? If you said strategic buyer, you're right, because the strategic buyer has a business purpose for your company, right? And money's not the issue a lot of times. They're going to pay higher if you find a strategic buyer, because either you're a competitor and they want to take you out of the market, maybe they don't have a footprint in the market that you're at, maybe you're a complementary service to theirs. There's something that you have that actually helps them as part of their growth plan, right? So there's a business purpose for their purchase. A financial buyer is generally not that type. The financial buyer is usually a cash buyer. He's looking to buy your cash. He's looking to buy your equipment. He's looking to replace his income. If somebody makes $100,000 at his corporate job and he wants to go start his own business, one of the first things he's going to try to do is replace his salary, right? So if he thinks he can get a $100,000 salary out of your business, he's more likely to invest. Now, a financial buyer also is trying to buy at a bargain, right? Because they're trying to get as much cash out of the business as they can. So there's a strategic buyer and there's a financial buyer. You want the strategic buyer, right? So when you're asking people, that's who you're looking for. Here's the watch it. Remember in the beginning I said there's watch it's all along? The watch it here is if you have one buyer, you have no buyers, right? I'll say it again. The successful business owner knows that if you have one buyer, you have no buyers. And what that means is that if you're only dealing with one person, if you're only negotiating with one, you're already at a disadvantage because this person can stretch you out. He can just wait, till you finally give in. You're not creating a sense of urgency. It's at his time, his pace, his terms, whether or not you sell. So if you have one buyer, you have no buyers. With that in mind, it's also how VC firms a lot of times will fund early stage companies, is that they'll be able to calculate your runway out and wait till that point in time when you might die, right? And then come to you with terms that are more in their favor. So think about that. If people just wait you out, you're going to be in the worst possible position because you might take a deal that doesn't favor you. So think about that when you go to sell your company. Now, there are 12 different ways. You probably want to know how we put a value on it. You probably want to know what it's sold for. And I'll tell you, there's 12 different ways for you to value a company, right? In this case, I used 2, right? And we'll go over 2. One of them was used to set the bottom dollar, the do not go below. The other one was used to set really the market price, what I was going to negotiate to, and to be able to justify it. So the first one is the asset approach. Now, this is one that I don't show the buyer, right? It's just between the seller and I. So Sammy and I talked about this approach, and it starts with book value. And what book value is, if you do the calculations, it's assets minus liabilities, or otherwise known as equity, right? So if you want to know the book value of your company, it's simply just that. Simply just that. It's the equity in your company. That's basically what we're talking about. So can I erase that? Yeah, good. So if we go back to his balance sheet, or we can go back to the balance sheet here where we looked at, we've been using the same balance sheet the entire time. So his balance sheet says, click in there, that his total equity was 1465. Year 5, that's his book value. We got assets minus liabilities equals equity. Okay, so 1465 is what we're going to start with for book value. From here, we go back to our asset approach, and we're going to write in that as the price, 1465. Now, here's the thing. When you look at book value, it doesn't take in any of the considerations about the market, right? If you remember about transferable value, there was the box, right? It was product, profit, people, potential, process. That's what determines how much above the value of the assets that somebody's willing to pay. That's the goodwill. In order to know about that, we need to go get an appraisal, right? So that's where the adjusted book value comes in, because it takes in all the other market conditions around your, around your company. I mean, you might be selling a product that's on a hot trend, right? Which actually people will pay a premium for. So you go get an appraisal. And in this case, we got an appraisal that came back $1 million over book. All right, so $1 million over book. So that means the appraisal came back at 2465. Now, you know what's funny? What happens if you get an appraisal you don't like? Yeah, just go get another one. That's all you do. So this one here was $1 million over book at 2465. That's where we start. Now remember, this is the asset approach, and this is going to set our bottom dollar, the do not go lower than. And in order to set our bottom dollar, we're going to have to subtract some things out, right? This is negotiation points. When you go and negotiate the sale or the purchase of a company, you negotiate points. You don't just say, I'll give you $1 million, I'll give you 750. No, you're going to negotiate specific line items. How much receivables will you give a discount on? How much inventory? This is going to help make sure you get the most value for the company. You negotiate specific points, and I usually start there and work on my way down, right? That's how I negotiate down. This gives me a plan for the negotiation as well. So in this case, we're going to set our discounts. So these are things we're going to subtract from the actual adjusted book value. So if I go back to, we're looking at receivables, inventory, and fixed assets, and then operating cost. So let me show you how to get those. Going back to the balance sheet, these are balance sheet accounts, balance sheet, balance sheet, balance sheet. That's an income statement. Those are the ones we're going to look at. So here I go back to the statements that we're working for. I'll start with the balance sheet. We were looking for accounts receivable, and currently we have $654,000. So I'm going to write these down and take them back to the account with us. So 654 is AR. And then we got inventory of 1.2 million. So inventory 1217. We also had fixed assets, right? And we're going to use the gross fixed assets number of 2827. So 2827. Remember, depreciation is yours. So you go back to what the actual assets are. Depreciation is yours. So the historical cost of the assets is 2871. Sorry, 2871. So assets. Now, additionally, we're going to go to the income statement, and we're looking at total operating expenses. In this case, we got $2 million in operating expenses, but that's for the year. So we got operating expenses of 2040, but that's for the year, and we're going to try to break that down into 3 months worth. So 3 months, we can divide that by 4. Let's go do the math real quick. Getting back to our valuation page, we've got all the numbers we need currently for this approach. Back to our valuation page. First of all, we're going to start with accounts receivable. We had 654 accounts receivable. We had inventory of 1217. We had fixed assets of 2871. And we had total operating expense of 2040. Those are the numbers we're starting with. Getting out my calculator, we're going to start up at the top. Now, accounts receivable. I'm willing to negotiate all the way down to 20% of the number, right? Meaning 80% is there. I'm negotiating the top 20%, right? If historically I've only ever written off 5% of my AR, I'm not going to go below that, right? Because I know it's collectible. I know it's something that we can collect on. So I'll negotiate down to 5%. Why 20? Well, 20 is usually the point where I can sell the receivables to somebody else, right? I can just go to a factoring company. They usually will give me 80% of the value, and they go collect it, and they try to get 20%. So that's why 20 is kind of my threshold. So with that, 20% of 654 is the discount I'm willing to give. 654 times 0.2, that's 131. So 131. And we take that times 0.20. That's how I got there. Now, that's the discount. Remember, this is all stuff I'm going to subtract. So these are all discounted. Now, inventory. You got to remember, people don't have to buy your inventory. If I walk through your warehouse and everything's dusty and old or it hasn't been sold and those type of things, I might choose just to go buy new stuff or even replace what you have and stop selling some of the things that you don't sell very well. So I may do that. Now, I'm willing to go down on 50 cents on the dollar. I don't start at 50 cents on the dollar. I try to get 90 or 80 or 75, but I can negotiate down to 50 cents on the dollar. At 50 cents on the dollar, I feel like I can go just put it in a warehouse and sell it for more than that, just piece it off. So he doesn't have to buy it. I don't have to sell it. Usually 50% is my threshold, and I can usually get somebody to take the inventory at 50%. So in this case, it's 1.2 million, 1.7. So we're going to multiply that by 0.5. At the 50%, that's 609. 609. And we take that times 0.50. Now, the next one, you might say, why am I doing 10% of fixed cost or fixed assets? Now, remember, if we got to liquidate this company ourselves, and that's kind of what we're evaluating this against. When I'm setting our bottom dollar, do not negotiate below, I'm assuming that we tore down the company ourselves and pieced it off and just sold it in pieces. If I do that, I've got to hire a company to come in there and help me sell the equipment. You know, they've got marketing behind them, they're auctioneers or anything like that, and they usually take 10%, you know, give or take. They take 10% of the sales price in order to make their own money. So my discount, and it could be lower, right? I mean, you know, we know we're not going to sell that equipment at 2.8 million, but at least if I set that aside, I'm giving that guy a good indication of what I will negotiate on. So 2871, and I look at this as commission, times 0.1 equals 287. 287, there you go, 10%. Okay, the last one is operating cost. when you tear down a company, when you liquidate a company, it takes time. So I set aside 3 months operating cost, just to be able to pay people to help me close it down, to be able to get through the process. About 3 months is what it takes to close the company down. So I'll set aside that money. Now, if the guy buys it, I'm willing to say, hey, I was going to spend that anyway. I'll give it to you in the form of a discount if you close today, right? So this is the last thing I kind of throw in. 2040 divided by 4 because I want 3 months, and that's 12 months worth, and that's 510. So I'm going to divide that by 4. That gives me my 3 months out of 12. So really a quarter. Okay, so my discount then is 131 plus 609 plus 287 plus 510. Boom, 1537 is my discount. So I'm going to subtract 1537 right there. Now, these are the two numbers I'm looking at. My appraisal value minus my discount. Remember, that's what I'm totally going to negotiate down. I'll negotiate all the way down to this. So 2465 minus 1537 equals 928,000. So that's the moment of truth. Remember in the very beginning, and I'm wrapping this all back to you, that's your transferable value. That, when I say it's the moment of truth, you got to remember what I said in the very beginning. I've seen too many people sit at the closing table, have a check pushed across the table at them. They look at it and go, oh man, that's not enough. I've got to go find another job, right? Because transferable value is, do I have enough money to do whatever it is I want to do next, right? Whether it's sitting on the deck or whether it's traveling the world, it's going to take you a certain amount of money. And if you got to recap that, remember, it's my annual cost of living times 25, right? You think you might live 25 years. So I looked at Sammy, right? I looked at Sammy and I said, hey, the worst case scenario, I'm hoping that we get 928 or higher, right? Bottom dollar. I said, so Sammy, if we get an offer at 750, don't take it, right? That's what it tells you. If you get an offer lower than that, you shouldn't take it and try to negotiate back up to that bottom dollar, because we've just did the calculation on, if we tore it down ourselves, this is what we should expect. So remember that 928 is our bottom dollar. Okay. And don't sell or show this to the buyer, or that's what you're going to get. Here's the one that we show the seller, how we come up with our price, right? Remember, our bottom dollar here is 928. 928. Now, I'm going to wrap two more things back in there that I've already taught you. One is EBITDA, right? The other one is the multiple, right? So you got EBITDA and you got the multiple. Remember, we talked about return on investment, ROI, and I described how you could actually create a multiple from that. Yeah, okay, it's wrapping back to you now, right? It's coming back. So we got EBITDA, and if you remember, all these numbers come off of the income statement. All those numbers come off the income statement to form EBITDA. And I have these memorized, so I'm just going to go through it. You can go back to the income statement and look if you'd like. Net profit after tax was 9, right? The earnings approach, we're going to do a multiple of earnings, a multiple of EBITDA. The interest that he paid was 129. We're going to add that back in. Taxes he paid was 2,000. We had depreciation of 183, which gave us EBITDA of 323. All right, that's where we start. Now there's some additions and subtractions off of this. Now that we're at 323, you notice I said I'm going to subtract out CapEx. This is the first discount I'm willing to give somebody when I'm selling off the multiple. Meaning that I already told you that when you buy a company, the purchase price is only the first purchase. There's always a secondary purchase of capital expenditure. And I gave you the example that when I bought my first restaurant, the first thing I walked in was with new POS, new cameras, right? I already had a capital expense with my first day on the job. This usually is because the equipment that they have is out of date. It doesn't work right. He hasn't been maintaining it because he thought he was selling the company. Whatever it is, you probably have a capital expense associated with it. So, and because I know that, I'm like, hey, I'm willing to recognize that you have other money that you have to spend. I'll give you what we normally spend per year on capital expense. So here's how I figured this out. Normally I'll take the average on the balance sheet. I'm looking at capital expense as the change in gross fixed assets. Right, the change in gross fixed assets. We know that he spent $1 million, so all of that is new. Like going, he's got all this new equipment. I'm not going to give him credit for that. He already gets the brand new equipment that we know is underutilized and under capacity. So instead, I went back to just this year. What was the difference between last year and this year? Because there wasn't a big expense in capital expense. So that's a normal year. It isn't a big expansion. So in this case, we went from 841 to 871, a change in 30. So I'm going to give him $30,000 in CapEx expense. That's just a normal year. So let me get back to, there, that's like a review. Should have just went back to there we go, good. We're going to go subtract out 30 right here. So that's where that number comes from. I just went back 1 year. If you've had 5 normals in a year in a row, just say, what was the last 5 years average, right? What we're trying to do is give them credit for money that has to be put back into the company. The next one's interesting. I call it family excess. It's also called like seller's discretionary income, owner's benefit. I mean, all of those things, you might hear it one way or the other. This is the money that owners take out of the company for their own personal benefit, whether it be, internet at the house, vehicle expense, country club memberships, long-term, health insurance. These are things that only benefit the owner, that also reduce the net income of the company, so they pay less taxes, but the owner gets the benefit. Family excess. What's interesting about this is that when somebody buys this company, that expense doesn't exist, right? It goes with the owner. The new purchaser does not have to pay for the old owner's long-term care insurance or his vehicle or his country club membership. This is stuff that goes away. So it actually increases the net income of the company, right? Which we use to increase the value. So all of this gets added back in. I worked with a company one time, and it's weird, all the stuff that people put in there. But I worked with a company one time, and down in other expense, right? So you got sales minus cost of goods sold equals gross profit, minus operating expense equals net profit. Then you have this other line below that, which isn't part of the business operations. It's called other expense or other revenue. These are things like if I'm getting rent off a building on my lot, it's not part of my business, my painting business in this case, it's other revenue coming in. Well, I saw 8 checks 4 times a year, so 2 every quarter, going out to 2 employees that I'd never seen before, right? They weren't on any employee roster. They weren't associated with, what I could tell, with the company at all. So 8 checks, and they totaled a little over $100,000 a year, right? 4 times a year, these checks went out, $100,000. And you know me, former trooper and things like that. I actually went to the owner and said, "Hey, I got to ask you where this $100,000 is going. That's $100,000 out of the company every year." The owner looked at me and says, "Mike," I says, "I'm a little embarrassed about this." He goes, "That's my sister." Right? When my dad turned the company over to us, he gave it to me and my sister. So at first, she and her husband were here trying to help us with the business, and they created such a problem that we found it easier just to pay them not to come to work. I said, "That's great. That's great." He goes, "Well, how's it great?" I said, "Because we can add that back in. Those payments stop as soon as we sell the company, right? That's part of family excess." I mean, I know that you were embarrassed about it, but that's actually money that benefits you in the sale. Now, I don't know what happens to them in the dissolution, but at the same time, that's money that goes back in. So when I looked at Sammy, his wife, and his son, they were taking out about $110,000 out between the 3 of them. $110,000 was going out just in family excess, which means they all had vehicles. They all had, Sammy and his wife had the long-term care insurance, little things that they just did. But there was $110,000 between 3 of them. So all of them were getting about $30,000 a year in benefit. Most of it was really in insurance in this case, but we're going to add that back in. So this equals the free cash flow. This is the actual cash that a person gets when he buys this company. So we got 323 minus the 30 plus the 110, 403. So we got cash running through here of $403,000. Now, here's where the multiple comes in. If you remember, I said, what's a fair multiple for a paint manufacturing company? And remember, the ROI of the average paint manufacturing company was 16.4. And when we take 100 and divide that by 16.4 equals a multiple of 6.1. That's where I would start. It's average, right? If anybody that walks in here should be able to get 16% return. If they're expecting a 16% return, they should be able to get a 6.1 multiple. So I'm going to take that by 6.1. And when I do, 403 times 6.1 equals 2458. 2458. Super interesting, right? Because look at what the appraised value was, 2465. So it doesn't matter how we slice it up. Now I have 2465 as an appraisal. I also have my EBITDA number of 2458, right? We're right around that 2.5 mark. And we could do this 11 different ways, and they're all going to be somewhere in that ballpark. You know, maybe 100,000 this way or 100,000 that way, but we're not going to be way off where one's 80,000 and one's 5 million, right? They're all going to be right in the ballpark. Here's the difference between the last one and this one. It says funded debt. Now remember, we take current assets and pay off current liabilities. We take the long-term assets when we sell it, the gross fixed assets, and pay off the debt. We owe $599 in long-term debt, right? And I'll show you what that means there. In long-term debt, back on the balance sheet, we have long-term debt of $599, year 5. So we have to pay that off. You might be asking yourself, why didn't we do that on the first one, on the asset approach? Well, it's because we assume that all debt's paid off when we say assets minus liabilities, right? We assume, hey, we don't have any assets, so we take all the money from the assets and pay off the liabilities. What's left is the equity, 1465. You can't do that in the earnings approach because we haven't accounted for the debt at all. The earnings approach assumes that the current assets of 2 million will pay off the current liabilities of 1.5 million. We still have to account for the 600,000. That's what we owe the bank. So back to our approach. When we subtract that out, this is the amount of money that Sammy would walk home with, right? 2458 minus 599 equals 1859. So now we're somewhere between 928 and 859. Here's where it got interesting. What do you think we went to market with? Yeah, I got 2458 in evaluation, and I got an appraisal of 2465. Yeah, we went to market at 2.7 million. Right, we're like, I want to start there and let somebody walk me back, right? Because now I got negotiation points. So with the market at 2.7, hoping to land somewhere between 18.5 and 928. Here's how we worked. I took the 3 names off of the piece of paper. I took those 3 names and I called all of them. Guess what they were? Yeah, financial buyers, right? They say, oh yeah, if I can get in there, I know Sammy's been around forever. That thing just seems to crank out. You know, if I can get it for a deal, I'll do it. That's not who we wanted, right? That's not who we wanted to talk to. So I just put them in my back pocket for now. What I did was partnered with a local broker. And when I partnered with a local broker, our game plan was to find other regional paint manufacturing companies around the area. So we called 5 of them, right? All across the Midwest, through Minnesota, all the way over to Tennessee, Oklahoma, down into, you know, almost Louisiana. It says somebody's got to want this. In the circle around them, somebody's got to want his territory of Missouri, you know, part of Arkansas, part of Iowa. Somebody's got to want it. Well, we ended up getting 2 meetings. Out of the 5 phone calls we made, we got 2 meetings, right? I still prepared 5 binders for both meetings. You know where I'm going with that, don't you? So what in the binders, I took all my ratio analysis and I wrote up a narrative on how it was an opportunity for the buyer. You know, First of all, they have $7 million in sales. There's a $3 million contract out there with True Value, on private label branding. They got $1 million in new equipment that's underutilized. They got too much inventory, so they can boost cash just by reducing the inventory right off the bat. They were misfinanced. I mean, all the things we just pointed out, their gross profit was just 1% less, which equaled up to about $100,000 in extra. They had $100,000 in too much operating expense. You see how I'm telling the story from a different perspective, which means as the owner, I should want that anyway, but as the buyer, I want him to know all the opportunities and ways he can make more money. I want to put all the information in his hand and paint the picture that this is the best opportunity on the market right now, because he's going to get a great dollar amount for a great opportunity. Now, I went to the first meeting in Oklahoma. When I went to the meeting, I had 5 binders. Why do I do that? I only had 2 meetings. The sense of urgency, right? I wanted to think, hey, I called them out of the blue. That means I must have called everybody, right? And I've got all these meetings set up. So I got the binder in front of the Oklahoma folks, and we talked about the opportunity. Went over to Tennessee, same thing, 5 binders. 5 binders just talking about the opportunity, talking about how great this company was, right? Gave it to them. Got on a plane, went back to St. Louis. 3 days later, got a FedEx in the mail from the company in Oklahoma with an offer. I looked at it and went, about passed out. I said, Sammy, we gotta get together. So I go and talk to Sammy. I said, Sammy, I got an offer for you. I want to go over with you. He says, yeah, we got 928, didn't we? I showed him the offer letter, and the first thing he said was, what are they, idiots? Because the offer was $3.6 million. Why? I wanted 2.7. They came to me in 3 days at 3.6 million. That was a company with a business purpose. And there was only one negotiation point that they wanted that Sammy wasn't giving up on. And it took us another 2 days just to get past that. But 3.6 million, think about that. A strategic buyer comes in at almost $900,000 over asking. They had a purpose. They already had a plan for his company. Matter of fact, it came out later, they had already talked to True Value and already had the contract ready, right? They knew as soon as they took it over, they actually was increasing $3 million day one. So I found that out later. I didn't find it out at the time. Now, consider that, $3 million as opposed to Sammy thought he was going to get 900. Big difference, big deal. It's about presenting the opportunity and making sure you understand where the opportunities lie inside your business. You want to know what the sticking point was? Yeah, Junior, right? Junior had to have a job, right? And Sammy wasn't backing off of it. He says, my grandfather, his grandfather built this company. He's worked or been around this his whole life. I can't just walk out of here and leave him with nothing. So after 2 days of negotiation, the buying company finally says, okay, we'll take him on. That's how it went down. Here's how it's happened since. Really super interesting, right? So how we got to the bottom dollar, we got to our asking price and what the true value was, and then we ended up with 3.6 million. I went back about 3 years later and just kind of stopped through it. The whole place looked different. It was cleaner, it had a better feel, more is busier, those type of things. I even looked a little bigger, like they'd expanded out even a little farther. I just talked to him, say, hey, how's it going? He said, Mike, best purchase we ever had. He says, matter of fact, it took us 14 months to clean this company up. All the problems I just told you, so don't think these are small problems. It took them 14 months to clean it up, right? Reduce the inventory, get everything going, get the sales team up and running and really producing at a high level. After 14 months, they said that True Value contract, $3 million was the start, right? That was just the start, Mike. He says, in this location, last year, we did 22 million, 22. Remember, they were at 7 when they bought it 3 years prior. They did 22 in 3 years, 22 million. Here's what's interesting. The average paint manufacturing company, makes 3.1%. Not this company, right? Solid processes, great people. They average 5% a year. So think about that. Times 0.05, roughly $1 million a year in profit. $1 million a year. If you look at that, not accounting for time, they paid that's almost 30% right there. 30% a year coming back on their purchase price. Now you account for time and those type of things as well. But even if it's 20%, right? 20% coming back to them. Still, that's a huge investment they make that paid off. 2 people hate me in Winstonville, Missouri. Just absolutely think I'm the worst guy ever. First one is Sammy. Gotta remember, for 30 years, he drove to that building, to and from his house there. He still lives in town. He goes by there. He still has employees that work there. So he heard all the stories. He saw all this happen. He doesn't like me because he says, man, if you'd have just got me the $300,000, I could have done that. He couldn't have. All right. In my heart of hearts, I know that he couldn't have, but he believes that he could have done it. Right. His wife's pretty happy though. She's done. She's got a little bit of money. She's living her life. Now Junior loathes me. He's not happy at all. First of all, he lasted 6 months. The only reason he lasted past probation, 90 days, was the fact that they thought it would look bad in the community. So they kept him on for 6 months. But under the management of a professional sales manager who's accounting for productivity and activity and expecting results, he just couldn't handle it. So after 6 months, he lost his job. Right? The company that his grandfather built, that watched his dad grow, he saw it slip away. He saw his future slip away. That's a cautionary tale. That's a watch it, right? In the meantime, this is an example of something great that did happen to this company. They actually was better off, I think, in the long run with the 3.6 million. So that's my story about Sammy, how we took it from just meeting him to selling his company in a matter of months. I really appreciate what's happened here. Now, let me show you what I actually do for a living, right? Yeah, of course I talk about this, but let me show you a product that can help you or your clients, you in the business, or if you're an accountant with your clients, monitor cash flow, right? We have a product at Finagraph called cashflowtool.com. Cashflow tool. So let me just shut this off. Again, thank you. That's our ratio analysis and financial management portion. And I want to show you a tool that you can try for free and work right there with EBS, and we'll get you up and running. We'll go out here, try it. If you go to cashflowtool.com, you'll see what I'm talking about. First of all, we got 3 separate words that we talk about. It's simple, it's powerful, it's predictive. All right, I was given the task of coming up with a new and innovative and reimagined dashboard, and that's what we did. Dashboards are kind of stale, they're a wall of numbers. We got something that works both on, iPhone, Android, on the desktop, doesn't matter where you are, it works where you're at, right? And what we're doing is highlighting all the anomalies that happen inside. You can try it for free. You can watch a demo video. But what we're doing is looking at cash flow at a glance. So to imagine this, think about a dashboard, and there's only certain little points that you want to pay attention to, things that are happening that are bad or impact your cash. That's what we've done. We've created a Facebook style feed that points out all the little things that, did you see this? Did you see that? I call it a Facebook style feed because it slides, much like this video is doing right here. It slides upwards, right? Plus I can comment with my team. So anybody I'm working with, my accountant, my banker, just my business partners, people that work in the business, I can communicate back and forth with them. I don't have to do any data entry. If you've got Quickbooks, you need cashflowtool.com. If you have a desktop experience, we're just an add-on inside the desktop experience. It's just a menu item after you add us on. If you're QuickBooks Online, we just connect through the web browser. It's super simple. You're up and running and have information about your company in a matter of minutes. Right? It works on any device, like I said. The second feature in there is the cash flow calendar. This is where we're telling you the future. Right? We're going out 60 days and telling you when you're going to run out of money. So you don't have to worry about not making payroll. You don't got to worry about, should I buy a truck or a computer? We're going to tell you when the right time is to do that. Most cash flow predictors They will take the invoice dates. Like if I create it on the 1st and it's net 30, they will predict that you're going to get the money on the 31st. Now, everybody in this call knows that my clients don't pay on the date of the invoice. Not generally. I got some that pay in 22 days if it's net 30, some that pay in 48 days if it's net 30. So we look at, if you got 100 clients, I look at 100 clients separately and individually and predict when they're going to pay, right? And I'm going to show you how all that works, but that's what we do. We've got an activity fee and a cash flow calendar that work hand in hand, alerting you of things that are happening in your business and telling you what could happen next. Inside the cash flow calendar is also some powerful what if scenarios, meaning that what if I get a new contract? What's cash flow look like? What if I hire a new employee? How does that impact my cash? So I'm going to show you how those work as well. Of course, we're looking for anomalies. We look back 25 months and say, hey, here's what normally happens. This is out of whack. It may be right. I mean, maybe your gas is more expensive this month because you got a new contract. But we're at least going to tell you it existed, that something different happened, right? So you're not just writing a check without knowing, that it's worse or better or whatever it is than it was before. And again, keeping your team up to date, just being able to communicate on the fly what's happening, right? And predicting with confidence, and I'll show you how all those type of things works. If you want to see a demo, it's right here on our website, cashflowtool.com. Just go down, watch a demo, and you'll be able to see how we do things. And of course, try it for free, no credit card. And even if there was a credit card, trust me, we've had accountants try to do exactly what we're doing. It takes hours, right? Because we'll pull on 24 different reports. We're analyzing every single payment behavior that happens between vendors and customers and your business itself. And we're doing all this in a matter of seconds. And you can do it in Excel if you want to take hours. So if you're the type of person who likes to mess with Excel and manipulate and type in things, this isn't the product. If you like a computer to do most of the work and show you what's happening, then we're the product for you. Of course, we've got some customer stories in there. We've got videos, right? Videos of the customers saying exactly why they love us or they like us. And simple pricing. Here's the thing. Pricing plans are going to change. This is the Founders Program. It's $19 a month. EBS may have a discount program for you. I mean, contact them. See what they can do for you, right? Contact them. If anything, I know that the pricing is getting ready to go up, and we're going to have tiered pricing. So if you want in at the lowest price, do this today, right? In July of 2018, the prices are going to go up, and this program won't exist anymore. But what you'll have is what we call the Founders Program, where you'll get the best product, the most features. Even if it's $99 in the future, anybody that gets in before the price increase in July will get a $19 price for our best product. Okay. If you would like to hear why we built it, I mean, here's our CEO, James, to kind of walk you through what his thought process was when putting this together. So let me show you what it looks like. All right. So here's the login. If I was to click the login, there it is. You can sign up or log in. And I'll just go ahead and put in, John at Campbell Consulting. Yeah. Oh, look at that handsome guy shows up. There you go. And this is our demo account. So let me show you. Oh, maybe it's not. Maybe I don't know what I'm talking about. There we go. Just mistyped it. All right. So when I first log in, this is what I've got, right? I've got these business strips. This is, imagine I'm an accountant, right? And I'm working with my clients, Brandon's Coffee Shop, Business A, First Choice Carpet Cleaners, Joe's Ski Shop. If I'm just a business owner, I'm going to have First Choice Carpet Cleaners because it's a sample company that you can kind of refer back to, and my own business, right? So those are the two that I'll have. And as we look across it, we're going to say, hey, we've got kind of an executive dashboard of things that are happening. We talked about days cash on hand. We've talked about how much cash do I have today, how many alerts do I have, what's going on, right? If I got alerts, I want to point those out to you. If I've got, this is kind of our cash flow calendar, just a glance view. Oh my gosh, look at First Choice Carpet Cleaners. We've got some red, something's happening. So I'll give you some information over there, no cash in, but we've got some cash predicted going out. If I want to see more about First Choice Carpet Cleaners, I can click on their logo. I can click on the activity feed. It does have a terabyte of document storage. So some people are getting out of email altogether for attachments or file folders and just throwing it in here because everything they need, the financial statements and the analysis is right there together. And of course, you want to manage your subscription, you can do that. So in this case, I'm gonna go to the activity feed. If I click on it, here's what it looks like. I've got my company, my settings where I can change anything about my company. I can add a logo like I've done, change my accounting package. If I go from desktop online, I can also schedule updates from here, right? Which means if I want you to just go look for any changes every month, every week, or something like that, I can. If I don't want to even have this business anymore, I can delete it, right? So that's kind of your settings bar up here. Then I can invite a user. These are other people that I want to work with me on my company, right? It could be my banker, it could be my lawyer, it could be my accountant, could be just other people that work for me at First Choice Pro. So here you've got, 2 owners, and then you've got their consultants working with them, and maybe CPA working with them. But it's simple to get people invited. You just put in a name and email, and they're invited to see everything that you're seeing and participate in the conversation. When I say it's like Facebook, I can't search for you, so it doesn't matter. This is a closed loop. We are a banking company, and security is of utmost importance. So everything we do passes through a Moody's style or a bank style level security check. So this is just communication between you and your team. Again, we get that activity feed. We got the document center. So if I'm sharing documents with my team, first of all, I get notified. Remember, we're a mobile type company as well, so you get push notifications, email notifications, those type of things. Where you can see that. If I click on the document center, here they are. I can just look at it, I can delete it, I can add documents, but we can use a tag system so you can back and find them later. It makes it super easy to find things, on the feed itself. And then of course the subscription, when I'm ready to buy, I just add my payment, right? Here's what I get. And as we have multiple packages, you'll see this page change. Okay, so back to the feed, back to the important stuff. Up top, this is the beginning of our custom card creator. In future versions of this, we're going to have custom calculations. We'll pull in data from other sources, maybe Google, maybe Yelp, maybe whatever, so you can have an all-in-one inclusive data source, data stream of what's happening in your business online. How do we view you online? The other thing is I can map, like maybe I want to do revenue per square foot. Well, square foot isn't in QuickBooks, but I can say, hey, here's what the square footage is. Every time revenue comes in, give me the square foot per revenue or square foot per employee. So be able to start to create it, and you'll see tabs go across. Right now I can just post a message, write anything I want, and notify all my team members. Or I can even set a reminder like, hey, don't forget we have a meeting, or somebody needs to do something, right? And I can put in a reminder where everybody gets notified. Now, the way our activity feed is set up, if you notice, I'm just scrolling and I've got a lot of information I can scroll through. So think about, you're in between meetings, you pull out your phone, you're just kind of scrolling through your phone, right, of what's happening. Up top are always the most important things, right? Up top is where we put alerts, like unexpected bills. Like, hey, your gas bill is normally $200, it jumped up to $790, and then we can have a conversation about why that happened. Other things we can do is, hey, these people haven't paid us. Remember, we talked about the speed of cash, and we talked about being able to increase cash flow. Sometimes if I'm waiting till the end of the month to know that people, waiting for my AR agent report, it's too late. I'm seeing this now every day and saying, hey, somebody needs to call them, and I can put my team in action just every time I see it, and I'll know who owes me every single day without having to go run a report. How much cash is on hand. If it's bad, we're going to alert you. If you got tax things coming up, here's a reminder. If you do something good, we're going to tell you that too, right? In this case, they had their best sales month. If payments come in, money that goes out. Some of this is for fraud detection as well. Like, hey, I didn't know we had this vendor. Who hired them? So some of it's just knowing what's happening in your business at all times. Because if you're like me, I'm always on the road, and I don't see all these things that the accountant or the bookkeeper is doing. The other part over here is actual cash flow calendar. On the cash flow calendar, again, I got kind of summary information up top, but we saw red, right? The reason why we came into First Choice Carpet Cleaner is I saw red, and these can be customized to any color, right? So if I go to calendar settings, I can say, hey, here's what my starting cash is exactly. And the heat map, I can say, I want to know when it's less than 3,000. We're going to default to like 0. Tell me when I'm run out of money. But that's not true for every client. Some clients say, no, I need to know when I'm less than $3,000. So the heat map changes based on whatever threshold you want. And if I don't like those colors, I can change it to any color I want to. That way, if I don't like muted colors like we chose, and I want bold, bright, vivid colors, I can change that as well. And if you don't like what you did, you can just say revert all changes, and it changes it back to the actuals, right? And we never write anything in the QuickBooks. We're just reading it and showing you what it looks like. So in this case, we say, okay, on the 19th, we go to red. If I click on the 19th, boom, I find out what happens. Oh, I only have $10,000 and I got $8,000 in payroll, right? So that puts me below my threshold of $3,000, which indicated, yeah, you're gonna, be below your threshold. If you notice these three little dots, that's the confidence score. We utilize AI and machine learning, and this is how confident. The more data points we see, you see a pattern start to emerge. Believe it or not, we all kind of operate in patterns. In this case, this happens so frequently, on every other Thursday or whatever it is, that we can predict with 99% accurately that you have to make this payment on that day. So in this case, the payroll days that we see, it's every 14 days, and it's usually about $8,000. So you might notice on other ones where it's less accurate. Let me see if I can't find one. Like here's one, a Chase business card, 75% accuracy, because look, the days are between 29 and 31. This is when we're going to make our credit card payment, and sometimes we pay 1,000, sometimes 5,000. So we can, be confident at 75%. Here's what happens if we're wrong. If you're like, oh no, our bill isn't going to be $4,000, it's going to be $3,000. You just change it to whatever number you want, right? And then recalculate it. Or if you're saying, I'm not going to make that payment this month, I just press hide and watch this number change. Boom, it puts it back in the cash flow. So you can actually hide what's there, or what if I don't pay it? Or maybe I'm just going to add a new item. I have a new expense and I can add that in. Or I'm going to get that new contract and I can add that in and see how that impacts the whole picture, right? So you can do what if scenarios, like what if I get a contract? What if I hire an employee? How do I manipulate the data and be able to see how it impacts cash? You're going to be able to do this. Know things sooner so you can act faster and anticipate tomorrow. Chris, I'm going to turn it over to you, buddy. This is 6 weeks, 6 great weeks. I hope that everybody has something they went to. Yeah. So, hey, sign up for your free trial. We'd love to see you. If you want a closer demo, you'll get emails that say, hey, click here to schedule a demo, and one of my team will help you. And I'm sure, Chris, you and your team can help as well.
Yeah, absolutely. You guys can feel free to, shoot me an email and I can get you over to the right people here on my team. And, either way, we can help you with all your QuickBooks software, add-on training, all that good stuff. So thank you, Mike, for all your time for the past 6 weeks. This was very educational and very entertaining too. So I'm sure I speak for everyone when I say that. I will follow up with everybody with a little bit more info about cashflowtool.com, as well as, how to access your trial and all that good stuff. And again, feel free to email me if you have any questions, and we will see you next time.
See you then. Hey, Cashflow Tool is for you.
Thanks, Mike.
Bye-bye.